Dear friends, welcome again. Today, in the fourth session of Theory and Practices of Personal Finance, I shall be discussing about the pitfalls of investing, which is basically responsible for the poor performance of our portfolio. You must have got this laundry list n number of times, right? We are not going to discuss that how the mismatches impact or allocation or my own behavior in terms of thinking long term and acting short term, etc. But rather we will be focusing on more about the journey itself, the decision making process, right? Which we many a times give a miss, right? So how the decision is made, where we can go wrong during this process, that is our discussion point today. I have tried to explain this with a very simple chart. The core of decision making is you, the inner you, which is about your habit, and then there is an outer you, which is about your money. Then you reach out to your advisor, who in turn suggests the funds to invest, where to invest, how much to invest, etc. etc. Then the next level is the fund manager that selects the stocks and creates a portfolio on your behalf. Sometimes advisors suggest stocks to you and you create your own portfolio, right? Now this seems very simple, but easier said than done. And one more point, if you notice, the biggest circle is where the God resides, which we call market, and who will finally decide your outcome. You will notice that as you move outside from the center, your control diminishes, reduces, and at the last circle, which is market, which is definitely not in anyone's control. So basically, the return is dependent on two factors. A, the decision making process, which is controllable, where we are keeping the inner you, the outer you, your advisor, or even to the extent of fund managers. And B, the market behavior, which is beyond our control. So first thing first, let us start with inner you. If you remember, we had discussed the three factors which are responsible for assessing your risk appetite. A, need, B, willingness, and C, ability. While need and ability can be quantified easily, willingness requires further probing, and it depends on two broad aspects. A, habit of saving in disciplined manner, and B, your sense of urgency. Sense of urgency of your goals and needs, right? Now, this is also the first pitfall. Since this is the first step, any deficiency, any shortcoming at this stage will jeopardize the outcome significantly. In fact, all subsequent steps are much less significant and have lesser importance in the outcome. So let's say, for an example, if you are saving 10,000 rupees a month and if you miss one installment, let's say fifth installment, so over a 30-year period, the value is just 3 basis points, 0.03%. But the impact is 100 basis points, which is like 30 times more than that. The next one is outer you, which is basically your investable surplus. Normally, we mix the mandatory saving and this investable surplus and treat as same. If you remember, we had discussed in session 3 a pecking order. That pecking order has to be maintained. The two should not be mixed and to be treated separately, but with the same level of urgency. Now, investable surplus is only after keeping aside the mandatory and forced savings. So let me give you an example. During this pandemic, if you recollect, banks have given moratorium on your loans. But it would be foolish for me to continue investing on one hand, whereas I have opted for moratorium on my loans on the other hand. Now think about it. What I am doing, I am trading the certain for uncertain. Now this can be disastrous. So this mistake of treating the two as fungible can be disastrous, not just financially, but even otherwise. So once you move out of yourself, the next important node is your advisor. He is the one who is going to be your Sarthi and will tell you where to invest, how much to invest. What I have often found that advisor becomes a good friend, and then you reach out to him or her, not just for financial advice, but even for anything else. But sometimes we are not very fortunate. We come across advisors whose expertise and incentive do not match. In fact, sometimes the incentives will have a conflict of interest with my interest and expectation. So basically, you need one good advisor, which basically means you need to check on his expertise, the incentive structure, how he's getting compensated, and if possible, personal references. Now, personal references helps in a big way because you are getting on the experience of someone who have already used his services. And then your actual Khiladis and Mohres, your ultimate investment bets. While we do check track record in case of funds, the business data in case of companies, but one has to appreciate the fact that understanding riskier assets need more specialization. These informations are like icebergs. What you get to see is just a fraction compared to what you don't get to see. So as the risk increases, you need specialized guidance to decode it. So it is at times better left to the experts than comprehending too little to guide you correctly. We also suffer a conundrum between too few or too many when we construct our portfolio. Now, if you have too many, proportion of each bet is so small that it won't matter even if that stocks becomes a multi-bagger. So likewise, if you have too few options, probability of getting them right is drastically low, nor they provide any comfort of diversification. So unless you have time and expertise with you, it is better to let professionals suggest or manage funds on your behalf. Sometimes we feel that we will create a portfolio of all winning stocks. I wish that was possible, but let me tell you, probability of identifying winning bets is abysmally low, given so many stocks and very few winners. In fact, the contrary is true, and it is not unusual to find your stocks of your portfolio often as a laggards. And this probability reduces your expected return dramatically, even when the return of those winners, those winning bets, is quite high. So once again, to keep things simple, just control what is manageable. Being experimental hurts, particularly when you can keep it simple. So this concludes the 4 sessions on theory and practices of personal finance. I hope you would have enjoyed this. I am thoroughly motivated with your responses. So till the next time, Namaskar.